Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's program, we're catching up with Jun Bei Liu of TenCap. I'm going to ask her all the sort of questions that lots of investors are asking me about whether you can believe in this rally. Should you be becoming defensive? Should you be worried about Donald Trump? All those sorts of things. And we'll look at some of the new ideas that have been introduced into her fund over the last few weeks. We'll then talk to Eliza Owen of Cotality. I was quite intrigued by a story they did about the suburbs and towns that have turned the biggest profit and the ones that have had really bad performances over the last few years. That's a very interesting insight into where you should be buying properties in the future and going forward. And now I've got an extensive interview with Rudi Filapek-Vandyck, the founder of FNArena. Now, we're going to give you a substantial chunk of that interview, but the bulk of it went well over half an hour, even longer. Rudy exposed to us all the things that he uses in identifying the best investments. We call this, it's a podcast, it's called The Diary of a Successful Investor, and that's exactly what Rudi Filapek-Vandyck has been for a long time. He's actually even created a business out of it as well called FNArena. So that's the show. Let's kick off now with Jun Bei Liu of TenCap. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
Okay. I want to start big picture first. Is there any reason why you might be worried about this rally? It keeps going on, particularly in the US, and we're not as excited as they are. But are you comfortable with what you're seeing on the market?
I am reasonably comfortable. We always thought the market will grind higher. However, we did think September was going to be a bit of pause because traditionally it's a bit quieter and people taking profit after the result seasons and the like. And this year kind of is sort of holding together okay. And usually in October, November and December is when market rallies into Christmas. I do think market is actually now positioning and consolidating quite well to be set up for that rally into Christmas because our corporate earnings okay. We're seeing retailers seeing improvement in the consumer front. You've got rate cuts already, quite a few coming through.
And growth has picked up.
Growth picked up, and so cyclical companies doing well. Growth companies not doing too badly either. So and then it's well supported by globally rate cut the valuation for these companies. So I think all of that really positioned well into a good November and Christmas rally. This month, I think next couple of weeks you might see a little bit more volatility. Our market's down a little bit, but it seems like market's holding together quite well.
What if Trump and China start having a real Barney, a real argument? Will the market be spooked by that?
Yeah, I think market will. At the moment, market's operating based on the assumption some sort of deal will come through, but they don't require the deal to come through now, but they just need continuous progress towards something. And it seems like that is what is happening every time when there's a meeting.
Yeah. And it also seems to me is that even though Trump can threaten investors' confidence, he seems to pull back. And a classic case is what he's doing with TikTok. Like, he's suing the Murdochs and he's offering them a chunk of TikTok. Like,
That's right.
and it's kind of what the market likes, is that he's not really going all out, declaring war on everybody. And it's a classic example of and like the TikTok deal is important to the whole China-US thing, isn't
That's right. It's super important. That was one of the key thing, and market was a bit worried about that. It's gone through actually pretty pragmatic. I think it goes to show if there is any volatility or if there's any negative headline, it actually is a great buying opportunity. I doubt it will come because market has looked through, like you said, some of the headlines that he put it out.
Do you ever invest in your fund overseas?
Not yet. We keep it
Not ruling it out.
not ruling it out because there's just a lot of opportunities.
Yeah.
In fact, over the last many years, we followed quite a lot of Asian and global stocks. A lot of them are very, very interesting. Australia, while we have our great companies, it's just a very small pool of businesses, right? And then when you want to find growth, and in many sectors, you find them in Asia, you find them in the US. And what's great is that, what do you call it? The segregation between the US and China over last last decade and for many decades to come. That means two sets of infrastructure, two sets of, these different sort of businesses that operate in these two different regimes. So it's very interesting.
Yeah. I must admit I was surprised when I looked at what WCM invests in, and AppLovin was its number one holding, which is up about 500%.
Yeah, it's been incredible.
Yeah.
These opportunities are very, very common in overseas, whereas here just a little bit harder to
Yeah. Okay. Well, we wanted to find one of those for us. Boss Energy. It was down a couple of weeks ago. They had a nice gain on a Trump and request for a uranium stockpile. I know at times you've liked Boss Energy, then you didn't like it. What's your current position on Boss Energy?
Look, actually, we don't have a position in the Boss Energy, but in terms of uranium, I think it's well positioned for the time being, for the next at least the next 12 months to 2 years, just because of all the positive rhetoric coming through, and we don't have a solution for energy shortage. So I think that whole space is looking very interesting. Recently we participate a lot of deals like Paladin raising money. You got Silex, which has a technology that helps improve the uranium
energy around Friday.
Absolutely. And so, these companies will give you really good exposure into the whole uranium. And quite frankly, I think, people are not really buying the fossil fuel at the moment. So looking for that alternative source of energy.
Would you say that you're not long uranium because you think it's a long wait and you're going to make money short term as well as long term? But for a long term investor, believing in the uranium story, do you think that's a believable story for a long-term investor?
I actually think uranium is a pretty good story for the next few years, because you just can't get them out of the ground easily, and you can't enrich them properly. So I think the shortage and the demand is so strong compared to the supply. That means the price is going higher.
Yeah.
That means the company who actually already in production is actually doing great. So I actually think you would have it in your portfolio. I think one thing you just got to be cognizant of is they're very volatile companies.
Yeah.
You can't have too many of them.
Yeah.
Not all your eggs in one basket, right? Have a small portion of it and give you that.
And what about Pro Medicus? Is it too late to buy Pro Medicus?
Not at all. Not at all. This is one of the companies that kind of you just keep holding. You look at the consensus sort of expectations or forecasts, say in 5 years time, and you base on what company sort of category they're already in. They just got into the cardiology, the one contract, and they got into pathology as well. And then look at the potential addressable market, and they give you some sort of expectation of what they think it could be. Consensus is still only 50% of expectation of what company think it could be. I just think people will always underestimate growth companies like that, because we want to be cautious. We want to only be upgrade when we get there, right? So there's been no reason to sell this company over the last many years, and you kind of just you take profit a little bit here and there, but it's something you always hold in the portfolio.
But wouldn't you be better off waiting for a crash and buying it then?
Very rare. I'll probably be sold, I probably would have sold it 5 years ago if I just took profit, because at the time we thought $30 times earnings was very expensive. And but the market condition changes. So, now that everything, even Woolworth is on, actually Woolworth 25 times or so. So everything, it's because there's been so much liquidity, the valuation perception has really changed. And particularly in Australia, there's scarcity for growth. Once you find your winner, you stick with it.
Okay, what about the lithium play? I am part of the reason why I'm asking this, because a lot of these, I think one day we'll have a lot of batteries, we'll have a lot of electric cars, and I figure some of our miners in the lithium space are going to do well out of it. This takes time. The world isn't ready for EVs yet because charging stations aren't numerous enough, cars don't go far enough, all that sort of thing. Do you believe one day it will all change and our lithium miners will do really well?
I think it will do better than it is today. Today is, lithium price is still pretty low. The reason they're at the moment going up, going down, going up and going down is because in China, they keep shutting down a lot of those mines because they're not licensed properly. So China's trying to actually stabilize the lithium price. Now, lithium feels a little bit like uranium. many years ago, lithium was a bit like that because there was so much demand in EV and there was not enough ready to use lithium. So the lithium price went through the roof and everyone try and dig and they realize it's everywhere. And then lithium doesn't actually need to go through that enrichment process. So it's actually you pull it out, you do a bit of things and then you use it. So then suddenly we have this glut in the last few years and demand slowed down a little bit. Suddenly we're stuck in that thing. Now we do think the demand's actually been improving for quite some time and the price needs to stabilize. You need more mines shut down and suddenly, these lithium miner, you don't need much movement. They will make good money.
Would you buy PLS or Min Resources or
I think PLS is the easiest one to buy. It's got heaps of cash, tons of cash sitting on the balance sheet and very leveraged. 20% of the register is still short.
Yeah.
Mm.
What about gold?
I like gold.
Yeah.
Every
What
portfolio.
are you holding in your
I've got small because the small gold give you bang
Yeah.
for buck, right? And they're exposed to the spot gold prices. So I've got Capricorn, I've got Catalyst,
Yeah.
and I've got Genesis.
Yeah.
Yeah, and then Northern Star is the one sort of laggard, hasn't happened, sort of had a bit of production issues. It lagged everyone else, so potentially have some upside. I also have tiny bit of Newmont, but we've been taking profits. It's done so well.
Yeah, okay. Do you think gold's going to keep going higher?
I do think it's well supported. I think gold price is I find it very hard to call, but I always have it in my portfolio as a diversification. Bit of gold, bit of everything else.
Has Trump been good for gold prices?
He has.
Yes.
Also Bitcoin. Unfortunately, we don't have any exposure to Bitcoin.
Do you think one day you might?
Absolutely.
Yeah.
I think the Bitcoin absolutely becoming institutionalized, as an asset class.
Yeah.
However, regulation is still coming in. So ultimately, which one will be the good one? So we're watching them. But I think it is increasingly becoming like more institutionalized product.
Okay. What's the Jun Bei Liu best idea this week?
Yeah, I need to have a think about it. So best idea this week. This little company. I'm not sure if I spoke about it before. I may have.
Yeah.
Cuscal.
Yeah, it's the old credit union.
That's right. It's a back end and then lid.
Do you really like
I really do like this company. Still not
What's the ticker code?
CCL. Old Coca-Cola's
Yeah, okay, yes.
Yeah, and so it's still yet to be discovered by everyone. It's not.
Well, what's this competitive advantage?
Oh, so essentially it's the back end for, has a connection to majority, except the large banks, but
Non-bank lenders.
not actually small banks, right? So because it's formed by all the credit unions and things. So
and they've got banking licenses now.
that's right. And then they provide all the back end to digital payments. So, there's a huge amount of leverage for the business. So every time you tap, it's them doing the job. Now, I thought there's a couple of other guys that do it themselves, but it is very essentially they almost control the market that's not belong to the large top four, right?
Yeah.
Top four does it themselves. So it's very, very interesting space. And what's really great is the acquisition opportunity within that's so fragmented, and they're the largest one. So they recently bought some things, 25% earnings accretive. There's a lot more to come through. So they're very well run, conservative management. It's very expensive.
Okay. That's CCL. Now, have you heard anything about Tyro and allegedly two suitors wanting to buy it?
I think Tyro at some point will get taken private. I'm surprised it's taken so long for him to come.
There was a issue offered about $1.60, but potential capital, wasn't it?
That's right. Yeah. So I think that one is not going to be listed for very long. That whole payment space is fascinating, and particularly in the environment where the rate is going the other way. I think
I mean, you still like Zip in the payment space?
Yeah, absolutely. Is if you got to keep going.
It's a lot of enthusiasm, but it has risen a lot.
It was a lot, but you keep it. It's growing at 50%, 40 to 50%. But I think it's still getting more supporters back. Even though it's gone up a lot, but a lot of people actually just hasn't looked at this sector for a long time, the payment space, and now gradually getting them to come back.
Is there less regulation threat to that sector? Because I think a lot of people got a bit toey when they thought, well, hang on, they've done so well. There's hardly any regulation. Lots of people were calling out for regulation. The banks were probably wanting to be regulated, but they seem to be growing. There's less calls for that kind of thing.
Yeah, that's right. Because now it's actually been going for so long, they're actually a meaningful alternative to other payments, right? Initially, when they first set up, people weren't sure is a credit product, is a not credit product. So we actually seen more regulation in the last decade, coming through to address this. And many of them say it's okay, and as long as you're within those guidelines. And we also have seen how these products work as well during a credit cycle during the pandemic. So we initially thought, oh, the company will just lose all these capital, but they don't. They just stop lending. If someone doesn't pay it back, they don't lend them. So there's just no growth. So it's actually a very, very capital light, very interesting business model. But it's definitely more with.
And I guess there's going to be a bit of takeover activity because there's a lot of small ones in there as well, aren't there?
That's right, in that whole space.
Yeah.
And recently we just had Kalana just listed
Yeah.
at a really, really good multiple in the US.
And it really hasn't been a great performer compared to Zip and Block and Afterpay. Yep. Okay. Anything else you want to tell him?
I think at the moment in the market, there's a lot of laggard the company. Market is very momentum driven. As yet, they want to buy companies that has earnings upgrade and sell a company that's got some issues. I think there are quite a lot of companies that we're looking through, and I think it looks very interesting. Domino's, for example, is one I think it looks very.
It's taking a punt on Domino's.
Yeah, absolutely. I think it looks very.
Because the share price is low, is a company coming out with something new like fat-free pizza? It is not just a lie.
Domino recently, actually, it's a bit better than I expected. But I think look, the share price is very, very low now. It's one tenth of the share price compared to a few years ago.
Yeah.
And with the price now, it is not pricing any. Of the possible turnaround. Companies spend so much money on corporate costs. They just need to cut slightly and give some back to your franchisees to help them to stimulate the demand. And but most of it will go back to the bottom line. You don't need to do much to get double-digit growth on less than 12 times. Look at Collins Foods. It was here 4 months ago, got up 40% and still going higher.
Yeah.
So I think
Collins has got KFC, hasn't it?
that's right.
And I think Sizzler still exists in some states.
Yes, and they got not the burrito. What's the Taco Bell
Right.
that they're going to shut down.
Yeah. They're going to shut that down.
Yeah, apparently it's not working as well.
Yeah. And it's so funny because Guzman and Gomez worked. That's Mexican, but Taco Bell's been around. It's an American franchise as well, isn't it? Anyway, we're not here to discuss that. So Domino's is your hot tip from
That's right.
From the kitchen. Great stuff. Thank you for joining us.
Thank you, Peter.
That's Jun Bei Liu of TenCap. My next guest is Eliza Owen, who's head of research for Cotality in Australia. And we're going to be looking at the suburbs that have turned the biggest profit and the towns, as well as the towns and suburbs that have been big losers in the past. Thanks for joining us, Eliza.
Thanks for having me. Great to be here.
Okay, so I read your story last week where you looked at the profitability of suburbs, both good. In fact, the words losers and winners were created. Did you guys create those words, or did some nasty journalist do that?
Oh, look, probably a bit of both. We call it the pain and gain report, which can be a bit of a nasty title as well. But thankfully, most people make a gain. So there's a lot of good news in there.
Okay. Let's just talk about the big gaining suburbs. And a lot of them were regional. That's a thing you pointed out. I think we saw Kiama, Byron. No one was surprised about Byron. Maybe Kiama's a bit of a surprise, even though I think it's a wonderful area. But what kind of staggered me was the numbers that you had there. So within the case of Kiama, you had a median gain of about $752,000. Over what time period would that have happened?
So we're looking at the June quarter, but importantly, it's not quite suburbs, it's the local government area. So we are broadening the market a little bit. And as you say, we observed a median profit from resale of over $750,000. That was a median of over 80 resales. So for that to be the median is pretty extraordinary. But they did have a relatively long hold period too, averaging 12 years. So it's that time in market as Kiama has really grown as a popular sea change area, getting spillover of demand from Sydney, and of course the COVID-related boom that a lot of regions went through that's delivering that high level of profit.
So to arrive at a number like 752,000, you're able to put in a average hold time of the sellers. And
So, yeah, I mean, this is a really good question.
the borrowing number that you had was close to that, was what, 718,000 or something. I'm not wearing my glasses, so I might be a bit more or less. But the whole period could have been shorter in the case of Byron, or exactly the same?
It would have been similar in Byron. Byron, as I think you're alluding to, it's a bit of a surprise because it's not a market that's exactly back at peak levels. It's still well below its peak in 2022. But we're talking about time in market. It's really where a lot of properties have been held for a relatively long time. Now, your point around the methodology, that's a really good one as well. Because Cotality has this rich history of property data and transactions, what this report does is we look at historic sales relative to what is sold in the June quarter. So we're looking at resales. We look at their June quarter result. We compare that to when they were previously sold. And that could be all the way back in the 1980s, right? But from that, we're able to derive the median gain. And it's gross profit, it's nominal profit. So some of them are going to look really big, and it's not like the seller is pocketing all of that, but it's that whole period where people have held on to these properties for a long time, which I think is why you're getting some of those really big numbers.
Yeah, and also what you're talking about is return on investment, but as you probably alluded to as well, some of these places may well have been very different from when they first got them. They've been renovated, they've been extended, and all that sort of stuff as well. What I also noticed when I'm looking here is that there's a lot of beach locations as well that have done very well. Is that something you're seeing in all the data, that seaside properties have had fantastic bounce, profit creation over time?
Yeah, absolutely. And it's not just in regional Australia. So the Northern Beaches was right up there as one of the most profitable areas as well. And that's quite an affluent area too. So you may not have had to hold your property as long to make the big bucks, but that had a median nominal gain of over $500,000. We also saw, I mean, just generally speaking, in terms of the incidence of making a profit, Greater Brisbane, almost 100% of resales made a profit in the June quarter. And there were a lot of pockets of Adelaide, 6 local government areas across Greater Adelaide where 100% of properties sold for a profit. So for those cities, it kind of comes back to the fact that you've had a very big increase in values in a relatively short period of time, really minimizing the chance of anyone making a loss from selling a property.
Yeah, I want to go back to the performance of Brisbane, Adelaide in a moment, and I think compare it to what's happened in poor old Melbourne of late. But let's just look at, and by the way, looking at the winning suburbs, I feel as though you could have even had a headline, "Follow the yuppies and you will make a lot of money," because nearly all of those places is where yuppies want to be, and, I know a yuppie that lives in Wallara that's done very well. Adelaide Hills, of course, if you're a wine drinker, you want to be there, don't you? And Surf Coast down in Victoria, it's all where you expect. So it's like follow the money, follow the yuppies.
I think that's to your point about gentrification as well, because one of
Very
the
nice way of saying that, Eliza. You're much nicer than me, but go on.
The reason that these areas have delivered so much from one point of sale to June 2025 is because they've come off a relatively low base as well. So areas like Kiama, areas like even Surf Coast of Victoria, Adelaide Hills, they're areas that have garnered a lot of interest over the COVID period. People were able to realize that reality of living in a lifestyle area because of the normalization of remote work, and that's really lifted these areas in recent years as well.
So let's go to the losing suburbs, as they were called. They still did pretty well. It's just on a comparison basis. But so some of them were really terrible, weren't they? But they tended to be very isolated locations, weren't they?
Yeah, so some of these areas were, Isaac, for example, in regional Queensland. Some of them weren't so isolated. So, funnily enough, even though the Northern Beaches was one of the most profitable areas across Australia, of the loss-making sales, it also had the biggest median loss of around $80,000. But that just represents the difference in the kinds of sales. So, for example, those loss-making sales in the Northern Beaches would have been held for a relatively short period of time. They tended to be units, maybe of more investment-grade quality. But yes, generally speaking, there was some of the more isolated resource-based markets that hadn't quite recovered value from previous peaks. And then, of course, like you say, you've got Melbourne, in particular, inner city Melbourne, where pretty much half of resales in the quarter made a loss.
Mm. Yeah, I was looking at, but even like a suburb like Stonington, um, loss of 47,500. Now that has suburbs like Armadale in it, doesn't it? And Paran and all those sorts of things. Why do you? And I would suspect that it's the worst part of Stonington that has probably had the biggest losses, while the places like Armadale would probably kept on going up and up. But Stonington is a very big local government area. Has there been something that's been going on in Victoria which doesn't seem to be going on elsewhere?
Yeah, I mean, there's a few what I would call problem pockets. So these are really high density investment grade unit builds
Yeah.
that just haven't moved in value in a really long time. In fact, when we look at Melbourne's unit market, the local government area, values are actually down in nominal terms over a 15-year period. So you could say it's kind of oversupply. In terms of what's been going wrong, I think there's many factors at play. In the 2010s, you had this big off-the-plan apartment boom that was kind of punctured by bank lending standards towards the end of the 2010s.
Yeah.
It had, through COVID, issues with economic and population growth. And then more recently, you've had things like changes to investment property taxes, charges, and compliance. For example, from the start of 2024, lowering the threshold at which you pay land tax. And that's really just turned off investor demand, which has kind of compounded problems in those investment markets.
Isn't it funny? You would have thought that politicians would have learnt from when Bob Carr and Michael Egan did the same thing here. You're probably too young to remember that, but like Sydney's house prices went sideways for at least 5 or 6 years, and it was related to the tax changes that really spooked the investor market. And you're right with Victoria. Anyone who's been around, you know, Jeff Shed and all the other areas around the Yarra, all the apartments that have been built in Docklands is extraordinary, isn't it? And I guess it's oversupply of that kind of property.
Yeah, it was a very and look, I'm speaking back to the 2010s because that's when I started researching the property market.
Yeah.
It was a very particular product for a particular time. There was a lot of speculation, and that's partly why developers were building for investors who were buying off the plan. And that stock hasn't quite stood the test of time when it comes to demand because those type of investors aren't really in the market anymore. It's sad. It's a bit of a failure on a lot of fronts because not only has it not delivered for investors, but it's not popular with people who want to buy owner-occupied housing. Of course, the 2010s was also associated with a lot of building defect issues. So it's a bit of a dark mark on our history of construction, not just from a profitability perspective, but now from this kind of owner-occupied perspective as well. Even where these dwellings are quite affordable, no one really wants to buy them.
And there was also a period where Chinese investors were buying a lot of that stock. And of course, those guys now can only buy new stuff. And I think the Chinese government also made it a lot harder for Chinese investors as well. So there's been a lot of moving parts to explain this Victorian problem.
Yeah, the Chinese investment is an interesting one. It's one I heard a lot about anecdotally in the 2010s, but I never really had any data to verify that. But I agree. I think the capital outflow restrictions in the late 2010s probably had some impact to demand in some investment markets. The limit to established property purchases on foreign investors that was introduced recently, I don't know how much of an impact that would have, because from the Foreign Investment Review Board, at least, that is one data source we can observe, suggests only about 1% of Australian transactions are through that foreign investment process. So it's kind of hard to say. But yeah, many factors at play.
Okay. One last question, Eliza. I'm sure everyone watching this interview will be asking the question. Yeah, is this house price rise trend going to keep on happening with lower interest rates and a supply problem?
Yes, I mean, it seems extraordinary because of how unaffordable housing is, but everything kind of points to housing values continuing to rise at the moment. Coming into the spring selling season, as you say, we've got lower interest rates, also more real income growth. So that's more money in household pockets that can be put towards borrowing capacity. On the supply side, like you say, we've got issues with new construction, which is generally completions have been trending lower. But even listings on the market are really low. We've got about 121,000 properties on the market for sale over the past 4 weeks. And that's almost 20% below where total listings would usually be. So it's definitely a seller's season this spring. And it's reflected in higher clearance rates and the rolling 28-day change in home values nationally is continuing to ramp up, showing about a 0.9% growth rate, or sorry, 0.8% nationally at this stage.
Do you agree with me? I'm happy if you say no, you're wrong. That seems to me the only thing that's ever going to spook this market is if unemployment goes through the roof.
I think that's it, because at the moment, financial stability is such that if property prices do start to go down, people are pretty good at servicing their mortgages. There's no urgency for them to sell, so they can keep their property off the market. That restricts supply and it keeps values moving higher. So to your point, if something goes wrong with mortgage serviceability, like a big lift in unemployment, and people do need to make these forced sales, that's what's going to compound supply, compound a downturn in values. I think from a policy perspective, there are things you can change on the demand side, like, as you say, with disincentivizing investors, that can sideline property values. But obviously that comes with consequences for future supply, for jobs and related activity in the property market as well. So there are some risks involved.
I guess artificial intelligence could be a threat to house prices as well, because if they take jobs, it'll lower prices.
I know you could be speaking to a computer version of me next time, AI version.
Let's hope not. I don't think I have much fun with the computer. Thanks for joining us.
Thanks for having me.
It's Eliza Owen from Cotality. And my next guest is Rudi Filapek-Vandyck of FNArena. I've asked Rudi a whole pile of questions to get an idea of what he uses to select the companies that he invests in. This is actually wrapped up in a new podcast that we're producing called Diary of a Successful Investor. And you can find this in anywhere where you get your favorite podcasts, the apps that you use to get podcasts, or you can even go to switzer.com.au. Rudi Filapek-Vandyck, thanks for joining us on this very special, the very first episode of the Diary of a Successful Investor. Thanks for joining us.
I'm stunned. The title. I mean, the pressure on my shoulders.
And Rudi, you've never been boastful about your investing, but I've known you a long time, and given what you've predicted, and like me, not always right, but certainly some of your big calls have been fantastic big calls. And both you and I know we're not always right, but what you've learned over the years is what I want you to share with others today in this interview. And I think I'll kick off in a more predictable way than I usually do with you. Apart from saying if I can't interview Charlie Munger, and I can't because Charlie's now passed away, and I can't interview Warren Buffett because he's a little bit too hard to access, I want to do Rudi Filapek-Vandyck. So thanks for joining us, mate.
Well, at least I'm more accessible than the other guys you're mentioning.
What first drew you to investing, and how did your approach evolve?
I not that long ago, I described my entrance and development in investment as basically a series of accidents. And luckily me, and maybe for other people as well, a lot of those accidents have actually worked out quite well. I mean, I originally started off as a journalist who would simply chase news, and that wasn't necessarily in finance. But by pure sheer luck, unplanned, I ended up on the business pages of a newspaper, and ultimately I became the editor of an online news service in Amsterdam. And from there onwards, I developed my knowledge of the markets, and ultimately I ended up in Australia. Ultimately, by accident again, I founded FNArena here, and it took until the GFC for me to change my focus towards which companies are better than others. And from then onwards, I developed a specific focus on high quality companies, which I have ultimately dubbed all-weather stocks. And I think that has also, it has developed, but that has also ultimately proven an alternative view to look at the market. And I don't think that angle is wrong. Let me put it that way. It definitely has taught me a lot. And one of the things that it has taught me is that simply because the share price looks cheap, it's not necessarily a good investment.
Yeah.
And I tend to emphasize more nowadays the quality of a company than the cheapness of the share price.
Mm. Rudi, was it your intention to create a business like FNArena that would effectively service your own investment goals as well? Or did you create the business and realize what you created was going to help you become a better investor?
Yeah, it's the latter scenario. I mean, as I said, it's a series of lucky accidents, and it just developed the way it did. And all in the first instance, it was never the plan that FNArena would manage its own portfolio, or that we would even develop our own philosophy in with investing and all of that. Originally, it just started off as reporting on what the stockbrokers were doing, and from then onwards, it just developed into something more. So it wasn't planned, but that doesn't mean I'm unhappy with the end outcome.
Yeah. What was there a defining moment or early investment that ultimately shaped your thinking, particularly around the all-weather approach to investing?
Yeah, as I said earlier, I mean, I've obviously witnessed the Nasdaq meltdown in 2000. That left an impression on me. I mean, I've seen the super cycle coming to its end as well in the commodities, but the deepest impression on me was the GFC, essentially, where you would see the majority of the market going down by 50% and more. That definitely left a big impression on me, and companies that previously were riding high on investor optimism, they were absolutely annihilated subsequently.
Yeah.
And how bad things became, and how little foresight, how little knowledge there was amongst investors about what was actually happening in the United States and what was causing the trouble. It taught me a lot. It taught me, but that I think, and from that, obviously, from there onwards, the all-weathers were born. That's where the whole the beginning started. But and yes, so those events definitely have left the biggest impression on me.
It's funny because around the GFCs where you and I got closer because you were on my TV show and we were both trying to work out what was going to happen. And it's funny, and I'm sure you've had the same kind of experience, but the person who taught me more about what was likely to happen was someone who's not really a stock market or wasn't a stock market flunky or groupie like you and me. It was Phil Riven. Do you remember Phil who started Ibis World?
Yes,
And
I do.
yeah,
Yes.
and Phil came on the show, and Phil was a great analysis of the historical trends of businesses and whatever. And I remember him saying, he said, the historical nature of stock markets are that they do recover, and he gave me sort of parameters of times when they should happen, and he pretty well got it right. Like when that March of 2009 bounce started happening, he was on the money, and he made the point it's going to be our top 30 companies that will be the fast rebounders. And it was actually, I found that really interesting. It made me look more outside of just the market people that you and I often talk to. There are other people who can offer insights that you would never thought before. And I'm sure you over time have learned that as well. You have to look beyond the people inside the industry.
That's one thing I can definitely vouch for. You have to have a very broad view, and knowledge and insights can come from all corners. It doesn't have to be from the usual sources. One thing maybe to point out here as well, Matthew Kidman, which I'm sure you know.
And I'm Matt. Yep.
He published a book in 2008 from memory, and
Yeah.
the last chapter of that book is where he asks the question, what makes a bear market, and when will it end? And I particularly paid close attention to that. He was pretty close on the mark there as well, in when it would end and things like that. And I've always been very surprised by those predictions that come true.
Yeah. I think it was called Bulls, Bear, and a casino.
And a croupier.
And a croupier, that's right. Yeah, yeah. So let's go at my next related question. How do you personally approach and or manage risk in your portfolios?
Yes. So there was a lot of insights I gather myself from reading a lot. So I'm piggybacking on other people's experiences, but nothing beats when you manage your own portfolio. And so I've added real time, real life experiences to the insights I picked up from elsewhere. And in my experience, I try to literally not take on risk. I try to manage it, and that, for example, that has led to the fact that I always have some exposure to gold. And where other people are asking me constantly, "Well, do you think gold is going to go to 4,000 or is it going to go to 3,000?" I actually don't care, because to me, gold is insurance. And that's one way of obviously of managing risk. What it also taught me is that a lot of things that people do are actually counterproductive. They're actually not as smart as they might seem on average. Like, for example, a very simple example: if I own shares in a particular company, and the company comes out with a big profit warning, share price dives. The last thing I do is immediately throwing more money at it. And a lot of people think that if the share price drops, you have to put more money in it. And that, I mean, I have at least a few dozen examples where that would have bankrupted me if I would do that. And if it turns out to be the right thing to do, that is more to do with luck than with anything else. There are many other examples. You will hardly find me ever dabbling in micro cap stocks. It's fine for people to do so, but it just doesn't serve my risk profile. I mean, I like to have a little bit more certainty, even though that is at times is a very very ephemeral, very naive proposition, because sometimes there is no certainty in the share market. But nevertheless, I try to put the money where there is at the very least less uncertainty than there is in the more speculative corners of the market, and that comes in many ways. I mean, I'm very considerate in taking on new investments and adding to existing ones, and that's not always dominated by what the share price does.
This is our new innovation in the podcast space, and I know a lot of people are always asking me, what have I learnt from the champion investors of the past? And so it's a great way of me actually answering your questions around something really important, how to invest successfully. So that's the show for tonight. Thanks for joining us. We'll see you next week.